Let's get more on the Canadian dollar from Shaun Osborne, Managing Director and Chief FX Strategist at Scotiabank. Thanks very much for joining us. Looking at both our currency and the Mexican peso, you think a lot of the tariff risk is priced in now?
Probably, I think, given the volatility that we've seen over the last 3 or 4 weeks, a lot of uncertainty still around the tariff situation. But I think as the US is slowly but surely moving towards probably a negotiated outcome here at some point soon, I think the markets hope. I think there's grounds for optimism that probably the worst, at least for the Canadian currency, is over. It's not to say we're not going to see some more economic damage from the tariffs themselves, but I think the bad news is essentially priced in here at this point.
If Pierre Poilievre wins the federal election on Monday, his policies, to use his cliche, might be seen as more business-friendly. Would that provide a boost for the Canadian dollar?
I think what's important for the Canadian dollar is that we get a clear winner. I think probably the worst outcome will be another minority government, which would indicate maybe a weak mandate to enact what either party is trying to propose here. So some pretty significant fiscal stimulus from both the Liberals and the Conservatives. I think what the markets will want to see is a clear winner and someone that has a mandate to enact either of those policies and deal with the challenge of tariffs from the US.
Looking at their so-called costed platforms, do you think both parties were guilty of economic assumptions that were too rosy?
I think that's not unusual for these kind of scenarios. Yeah. I think, there's some pretty significant assumptions in some of those numbers from the growth point of view, particularly, and how some of these programs are perhaps costed. But we run with what we've got, and that's what the voters will decide on, and that's what the markets will judge going forward. De-dollarization, the thesis that investors around the world have lost some of their trust in American institutions and financial stability. Is that a long-term trend that you see, move away central bank reserves from the US dollar? I think we've seen an inkling of that over the past few weeks. We haven't really seen, to be honest, any hard evidence of that in the data that we've had so far. But I certainly think the fact that we've had a situation where the US dollar, US equities and US government bonds have been falling in unison, it's very unusual to see that kind of situation, particularly in a developed market, certainly a large market like the US. That does indicate a loss of faith perhaps in US institutions. US policy making has been a little confused in terms of the tariff messaging, the tariff rollout. The kind of attacks that we've seen maybe on Fed Chairman Powell from the US president has also perhaps undermined confidence in Fed independence. So I think there is a shift underway, perhaps in the very early stages of a move away from the US dollar. I think we're in a situation now, given the outperformance of US markets, US capital markets over the last 10 or 15 years, that investors globally have found themselves passively over-benchmarked to US asset markets. And we're probably going to see some recalibration of how investors globally deploy capital going forward. I think certainly a risk for the US dollar here that we will see a move away from the US dollar. I think the dollar remains the global medium of transaction. It remains the global reserve currency, certainly for the foreseeable future. There's no danger of that situation changing. But I think we're looking at a situation where the dollar is still very strongly valued in broad terms against a range of currencies. The US administration is trying to rebalance US trade, global trade. An outcome of that, either directly or indirectly, it seems is going to be a somewhat weaker US dollar, either through policy or through the outcomes. A more balanced US trade situation effectively implies a reduction in the US trade deficit, which also infers a reduction in the US capital account surplus.
Right, because when you have a trade deficit, you're attracting capital from around the
Correct.
world.
So you're attracting excess savings, foreign savings from around the world to finance that deficit. So if we are looking at a situation where the US trade deficit is reduced by these policies that the US administration is pursuing at the moment, then by dint of that policy, the capital account surplus will decline
less demand for US dollars, less demand for US treasuries, presumably the dollar is likely to decline.
It's confusing, though, isn't it? Kind of counterintuitive. You would think a reduction in the U.S. trade deficit would be good for the U.S. dollar, but it doesn't quite work like that.
I don't think it's going to quite work like that, given the position of the U.S. dollar at this point. It's trading significantly, close to two standard deviations above its long-term moving average against its trade-weighted basket. So that's a case where in the past we've seen, both in terms of under and overvaluation, that seems to be a point at which the trend in the dollar does start to turn, either from undervaluation or overvaluation historically. So the dollar does appear to be strongly valued, and it does, I think, it is a likely outcome of this policy that we do see a somewhat softer US dollar emerge.
That's got to be frustrating. If you're running a tourist business in the US, you might think, well, lower currency, that's going to bring in visitors from abroad. But I think a lot of people aren't wary to be encountering the US border officials right now.
I think that's, and we've certainly seen that in the numbers, that from a Canadian perspective, the cross-border movement has been significantly reduced. And we can see from businesses that airlines are reducing flights to the US, not just from Canada, but globally. So that certainly seems to be an issue.
I've had some wonderful holidays in the States, California, Palm Springs. Oh, no, I'm going to miss that. Right. I don't want to go there right now. The Canadian dollar, the Canadian economy, looking over the next 1 or 2 years, our economy could outperform the United States?
Yeah, and in terms of our forecast, which my colleagues at Scotia Economics have just released, we do think there's, I mean, it's going to be a sluggish story for growth, both here and in the US. But we do think that the tariff hit may be somewhat more significant for the US in growth terms. So sluggish growth this year, maybe a mild outperformance for Canada next year. The Federal Reserve probably has a bit more easing to do. Some catching up with the Bank of Canada. So we do think that we'll see slightly more aggressive rate cuts in the US in 2026. That's not a story necessarily from our point of view anyway for this year. But I think the risk is that or if we do see evidence of slower growth emerging, recession concerns are clearly building in the US at this point. Those expectations could be brought forward. Markets are pricing in earlier rate cuts than we have in our forecast. So that's the risk of earlier rate cuts in the US is certainly there.
So to ask you an impossible question with so many variables, a year from now, do you see the Canadian dollar, a year from now, it's a long time, do you see the Canadian dollar higher against the US dollar, or the same, or weaker?
Yeah, I think there's scope here for the Canadian dollar does look very, very cheap. It has looked very cheap over the past few weeks. We traded down as low as 67.5 cents at the low around the volatility that we saw in the immediate rollout of tariffs. That left the Canadian dollar looking very, very cheap against the US dollar. So there's grounds for some improvement there. We think modest upside for the Canadian dollar over the next few quarters, so into next year, probably around to the sort of 72, 73 cent point. If this sell-off in the US dollar picks up momentum, which I think there is a risk, then that could extend to maybe 75 cents or even a little bit more.
Shaun, thank you very much.
Pleasure.
Shaun Osborne, Managing Director and Chief FX Strategist at Scotiabank. According to Bloomberg,